So let's talk about price to earnings and why that matters today. Okay, so to start off with price to earnings, I want to talk about how you determine what price to earnings is when evaluating stocks. And the price to earnings is taking the stock price, dividing it by the earnings per share. What is the earnings per share? It's kind of self-explanatory. It's how much earnings are in the company per each individual share. So if you pay $10 for a share, the earnings per share is $1. 10 divided by 1 gives you a 10 price to earnings. That kind of tells me how appropriately a stock is valued. A normal historic ratio would be about 13 to 15. I like to buy in single digits whenever I can. And I really kind of hold my cash off on the sidelines until I find things that I want to invest in below that 10 price to earnings. It has to be single digits. And when I get things in single digits for the decent sized company that is bound to grow, every single time it has grown for me. It doesn't matter where you buy it lately, it'll basically grow at this point in time, which is another reason to why I think basically that we're gonna have a stock market crash coming up here. I'm pretty confident in that. I've stopped putting cash into the markets. I'm holding off on the sidelines in terms of that, and yeah, I'm just gonna keep accumulating cash. It's been a while since I bought a stock, but once fear hits the markets, everything goes down altogether. Gold, silver, they may get hit. There could be margin calls. I've mentioned that a few times. PE ratio for the Dow Jones, it was just below 23 a year ago, which is a very high historic average price to earnings. Now, it's over 31. That's the average price to earnings on the Dow Jones. It's above 31 now. That is insane, at least to me. I am not going to be putting much money into the markets, at least not the NYSE at the moment. I may put some money into other markets, different stock markets, but in terms of companies traded on the NYSE, I'm really holding off because even if you find deals, once fear hits the markets, people start selling everything. And that's a big part of why retail investors have done pretty decent in 2020 and outpaced the big guys on Wall Street. Because when everyone was at home seeing the stock market crash, they're getting some extra cash coming in, at least here in Canada. We saw a lot of retail accounts get opened up, some of that extra income. A lot of people started their own business or something like that while they're sitting at home. So they got the stimulus money, we got the economic recovery benefit up here in Canada. So people were getting cash when they're unemployed, starting their own businesses, things like that. Yeah, use the extra income to pretty much invest. Drive up the stock market, create the bubble we're seeing today. Then we had Wall Street jump in because they said, oh, there's the bottom. Yeah, for me, I'm holding off though, because above 30 price to earnings is really crazy. I'm still looking elsewhere. I'm not gonna say I'm not gonna be investing in stocks or anything at all, because I don't see all stock markets crashing the same. I see different areas around the planet, things will be a lot different depending geographically where you are. With this price to earnings, it's kind of tells you how long you're gonna need to take in order to pay back what you invest, because it tells you what you're paying for how much you're earning, and it kind of gives you the time span based on last quarter's earnings. That's what it's all based on. They don't give earnings reports every single day, so it's all based on the last quarter's earnings. yeah, it kind of sums it up what price to earnings are, what my kind of guidelines that I use in my own investing are. When you do find some of those deals, when you can get it below the 10 price to earnings in single digits, you get some nice juicy dividend yields. When I bought BNS on the TSX, that's a Canadian bank, it was about 8.5 price to earnings, but it's getting I think it's just above a 6.5 dividend yield. That's a pretty decent company, set up for stable growth. Inflation could benefit them a decent amount. So I'm really not too worried investing in banks, financial institutions, things like that right now. I also don't want to be all in on one thing and have no kind of opposite side of it in my portfolio. And to have an opposite asset that pays me a high yield is pretty nice, especially since they've never cut their yield. They've stopped increasing the yield, but they never dropped it. As to my knowledge, throughout all the research going back through the Great Depression, all that time, no cutting yields in terms of dividends. So I'm pretty happy about that, and have something that's been paying me consistently 6.5%. Then you could choose to reinvest, buy metals, do whatever you want with that income. And then it's also buying that low, the price goes way up. So I'm sitting on some nice profits there, but now it's the 13 price to earnings, which is alright if you ask me. I'm not buying at that point, but I'm gonna hold. And I'm perfectly fine holding there. And that kind of sums it all up. What price to earnings there are, though, how I use it. But yeah, please like, share, subscribe. Enter my 500 subscriber giveaway too. There's not a lot of time for that. And yeah, stay positive. See you next time. Thanks. Bye.